Preparing for a financial analyst at Xcel Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Xcel Energy? I am interested in Xcel Energy because the role combines rigorous finance with a clear public service mission. Utilities require analysts to understand operations, regulation, capital investment, and long-term affordability, not just quarterly earnings. Xcel's transition toward cleaner generation creates complex investment and forecasting questions that match my interests. I would bring strong modeling, attention to detail, and communication skills while learning how analysis supports reliable service, constructive regulatory outcomes, and sustainable shareholder returns. While answering, connect your interest in financial analysis with Xcel Energy's regulated utility model, clean energy transition, capital intensity, and customer impact. Demonstrate research into the company rather than giving a generic finance response. Question 2. What do you know about Xcel Energy's business model? Xcel Energy is primarily a regulated electric and natural gas utility serving customers across several states. Its earnings are influenced by approved rates, operating performance, customer demand, fuel costs, and the level of invested rate base. The company also has significant transmission, generation, and distribution assets, including growing renewable investment. I would analyze performance by jurisdiction and business driver, recognizing that regulation and capital deployment are central to both cash flow and long-term value creation. Make sure to cover Xcel's electricity and natural gas operations, regulated utility earnings, rate base, allowed returns, capital investment, geographic footprint, and the distinction between regulated and competitive activities. Question 3. How do regulated utilities make money? A regulated utility generally earns revenue through rates approved by a public utility commission. The revenue requirement typically recovers prudently incurred operating costs, depreciation, taxes, and an allowed return on the utility's rate base. The rate base represents qualifying invested assets, such as plants, transmission, and distribution infrastructure. If the utility executes well and manages costs within the regulatory framework, it can earn its authorized return. Forecasting therefore requires understanding both financial performance and regulatory timing. In your answer, explain the rate-setting formula. Prudently incurred costs, rate base, allowed return, depreciation, taxes, and approved revenue requirements. Clarify that utilities generally earn returns on invested capital rather than simply charging market prices. Question 4. What is rate base, and why is it important to Xcel Energy? Rate base is the pool of utility assets that regulators allow a company to use when calculating customer rates and an authorized return. New approved infrastructure increases rate base, while depreciation and retirements reduce it. For Xcel Energy, rate base growth can support earnings and reliability by funding generation, transmission, distribution, and clean energy projects. However, growth is valuable only when investments are prudent, needed, and accepted by regulators without creating unacceptable customer bill pressure. Be sure to mention that rate base represents regulated investment, how additions and depreciation change it, the allowed return applied to it, and why rate base growth must be balanced against customer affordability and regulatory approval. Question 5. How would you build a financial forecast for Xcel Energy? I would begin with historical financials and operational drivers, then forecast each major segment separately. Revenue would reflect customers, usage, weather, rate cases, and approved riders. Expenses would include fuel, purchased power, labor, maintenance, depreciation, interest, and taxes. I would link capital expenditures to rate base growth and cash flow, while modeling regulatory timing explicitly. Finally, I would create base, upside, and downside cases and reconcile the forecast to management guidance and external assumptions. Focus on forecasting revenue by customer class and jurisdiction, operating expenses, fuel and purchased power, depreciation, interest, taxes, capital expenditures, rate base growth, regulatory lag, and scenario assumptions. Question 6. How would you analyze Xcel Energy's capital expenditures? I would separate capital spending into generation, transmission, distribution, environmental compliance, technology, and other categories. Then I would assess project timing, construction progress, regulatory approval, expected in-service dates, and the resulting rate base contribution. I would compare spending with the approved plan and examine impacts on depreciation, financing, and free cash flow. The key question is not simply whether CapEx is high, but whether it is necessary, executable, recoverable, and aligned with customer and strategic priorities. Make sure to discuss project categories, timing, regulatory authorization, construction progress, expected rate base contribution, financing needs, depreciation, cash flow, and whether spending supports reliability, growth, or decarbonization. Question 7. What financial statements would you focus on when analyzing Xcel Energy? I would review all three statements together. The income statement shows revenue recovery, operating costs, depreciation, interest, and earnings. The balance sheet highlights utility plant, regulatory assets, debt, equity, and working capital. The cash flow statement is especially important because large capital programs can create a gap between earnings and cash generation. I would also examine disclosures and non-generally accepted accounting principles measures, then reconcile them to reported results so my conclusions remain grounded in accounting economics. Discuss the income statement, balance sheet, cash flow statement, regulatory assets and liabilities, capital expenditures, debt, and non-generally accepted accounting principles measures. Explain how the statements connect in a capital-intensive regulated utility. Question 8. How do you distinguish EBITDA, operating income, net income, and funds from operations? EBITDA measures operating profit before interest, taxes, depreciation, and amortization. Operating income includes depreciation but excludes financing and taxes, while net income includes those downstream items. Funds from operations is a cash-oriented measure often used by credit analysts, typically starting with net income and adjusting for non-cash items and selected working capital effects. For Xcel Energy, I would use each metric for its proper purpose: profitability, operating comparison, earnings, or debt supporting cash generation. In your answer, define each measure, identify depreciation, interest, taxes, and working capital effects, and explain why utilities and credit analysts may emphasize cash-oriented measures alongside generally accepted accounting principles earnings. Question 9. What is regulatory lag, and how can it affect Xcel Energy's results? Regulatory lag is the period between when a utility incurs costs or places assets into service and when approved rates fully reflect them. During that period, earnings and cash flow can be pressured, especially after major capital investment or inflationary increases. Trackers, riders, or interim rate adjustments may reduce the impact, but they do not eliminate timing risk. In a forecast, I would model the actual regulatory calendar rather than assuming immediate recovery of every investment. Be sure to explain the delay between investment or cost increases and rate recovery, its effect on earnings and cash flow, the role of interim riders or trackers, and why timing matters in forecasts. Question 10. How would higher interest rates affect Xcel Energy? Higher interest rates would increase the cost of issuing or refinancing debt, putting pressure on interest expense, cash flow, and project economics. They could also affect valuation through a higher discount rate and influence customer affordability. Over time, a utility may seek recovery of prudently incurred financing costs through rates, but regulatory timing matters. I would stress test maturities, fixed versus variable debt, capital spending, interest coverage, and the pace at which higher costs could be reflected in approved rates. Cover borrowing costs, interest expense, project economics, allowed returns, customer rates, valuation, refinancing risk, and the distinction between short-term earnings pressure and potential long-term regulatory recovery. Question 11. How would you evaluate Xcel Energy's liquidity and leverage? I would assess liquidity through cash, operating cash flow, available revolver capacity, commercial paper access, and upcoming debt maturities. For leverage, I would review debt to capital, net debt to EBITDA, interest coverage, and funds from operations metrics. I would then compare those measures with capital expenditure requirements and management targets. Because utilities depend heavily on financing, I would also consider regulatory relationships and credit ratings, since a weaker rating can raise costs precisely when investment needs are high. Focus on cash balances, operating cash flow, committed credit facilities, debt maturities, capital spending, interest coverage, debt to capital, regulatory support, and rating agency considerations. Question 12. How would weather affect Xcel Energy's financial results? Weather can materially influence electricity and natural gas demand, particularly through heating and cooling degree days. Extreme conditions may increase sales but also raise fuel, purchased power, maintenance, and reliability costs. I would compare actual weather with normal conditions, quantify the volume and margin effects, and examine whether regulatory mechanisms offset part of the volatility. In reporting, I would separate weather-driven variance from underlying customer growth, efficiency trends, pricing, and permanent changes in consumption behavior. Mention heating and cooling degree days, customer usage, seasonality, fuel and purchased power costs, decoupling or adjustment mechanisms, weather normalization, and the need to separate temporary effects from structural trends. Question 13. How would you assess the financial impact of Xcel Energy's renewable energy investments? I would evaluate renewable projects using total installed cost, expected capacity factor, production, tax benefits, operating costs, transmission requirements, and timing of rate recovery. I would also compare them with avoided fuel costs and reliability needs under different power price scenarios. The analysis should include construction and permitting risk, not just headline capacity. A project can support long-term strategy and reduce emissions while still requiring careful review of affordability, execution, financing, and regulatory approval. Discuss capital requirements, operating cost changes, tax credits, production assumptions, transmission needs, rate recovery, fuel price exposure, project execution, and the balance between decarbonization benefits and customer affordability. Question 14. What is the difference between a regulated asset and a regulatory asset? A regulated asset is a physical operating investment, such as a power plant, transmission line, or distribution system, that may be included in rate base and earn an allowed return. A regulatory asset is an accounting balance for qualifying costs deferred because regulators expect future customer recovery. They are different concepts. One is an operating asset, while the other reflects timing between accounting recognition and rate recovery. I would evaluate both for recoverability, regulatory authorization, and cash flow implications. Clarify that regulated assets are physical utility investments included in rate base, while regulatory assets are accounting balances representing deferred costs expected to be recovered through future rates. Question 15. How would you analyze a variance between actual and budgeted operating expenses? I would first quantify the total variance, then build a bridge by category and driver. For a utility, I would examine weather, customer usage, fuel and purchased power, labor, maintenance, storm costs, timing, and one-time items. I would validate unusual movements against operational data and invoices, then classify each item as controllable, timing-related, or structural. Finally, I would update the forecast with a clear explanation, avoiding the mistake of treating every favorable variance as permanent savings. Explain a structured bridge using volume, price, timing, mix, weather, one-time items, labor, fuel, purchased power, and maintenance. Emphasize validating data and distinguishing controllable from uncontrollable drivers. Question 16. How would you value Xcel Energy? I would triangulate using a dividend discount model, discounted cash flow, and comparable utility multiples. The dividend model is relevant because regulated utilities often have visible payout policies, while DCF captures capital spending, cash flow, and terminal growth. I would benchmark price to earnings, enterprise value to EBITDA, and price to book against similar utilities. Key sensitivities would include interest rates, allowed returns, rate base growth, regulatory outcomes, capital execution, and the sustainability of dividend increases. Cover discounted cash flow, dividend discount, regulated utility multiples, rate base growth, allowed returns, cost of equity, debt, terminal assumptions, peer comparisons, and the importance of regulatory and interest rate sensitivities. Question 17. Why might price to book be relevant for a regulated utility? Price to book can be informative because a regulated utility's equity base is connected to its invested rate base and authorized return on equity. A premium may reflect strong regulatory support, attractive rate base growth, or an expected return above the cost of equity. A discount could signal execution, regulatory, financing, or credit concerns. However, book value is not enough by itself. I would also assess asset quality, capital needs, allowed returns, earnings growth, and dividend capacity. In your answer, link book equity to rate base, allowed return on equity, growth prospects, regulatory support, and the limitations of comparing price to book without considering asset quality and authorized returns. Question 18. What would happen if Xcel Energy's capital project were delayed? I would first determine whether the delay changes only timing or ultimately the project's scope and economics. A delay could postpone rate base growth, depreciation, revenue recovery, and financing needs, while increasing construction costs or creating reliability concerns. I would revise the in-service date, CapEx curve, cash flow, debt requirements, and earnings outlook. I would also review regulatory milestones and contractual exposure. The conclusion should distinguish a temporary earnings shift from a permanent deterioration in project value. Discuss delayed rate base growth, postponed depreciation, possible customer or reliability impacts, cost inflation, financing changes, regulatory consequences, revised cash flow, and the difference between temporary timing and permanent project cancellation. Question 19. How would you approach a new rate case analysis? I would begin by understanding the filing's requested revenue increase, test year, capital additions, operating expenses, depreciation, taxes, and proposed capital structure. Then I would calculate the requested rate base and return, identify major customer class impacts, and compare assumptions with prior orders. I would model alternative outcomes, including partial approval, settlement, delay, and disallowance. Finally, I would track the procedural calendar because the financial impact depends not only on the request, but also on when recovery begins. Mention the filing request, test year, rate base, operating expenses, depreciation, taxes, capital structure, allowed return, customer classes, regulatory timeline, settlement risk, and requested versus authorized outcomes. Question 20. What accounting issues are particularly important for a utility analyst? Important areas include regulatory assets and liabilities, depreciation, asset retirement obligations, storm cost deferrals, fuel cost mechanisms, pensions, leases, and impairment testing. Regulatory accounting can make reported earnings depend heavily on whether future recovery is probable and authorized. I would read footnotes carefully, reconcile unusual balances, and understand how assumptions affect earnings and cash flow. I would also separate non-cash accounting effects from actual funding needs, especially when evaluating leverage, dividends, and capital investment. Be sure to discuss regulatory accounting, asset retirement obligations, depreciation, impairment, pension costs, storm recovery, fuel deferrals, lease accounting, and the need to assess recoverability under applicable accounting standards. Question 21. How would you use Excel to support financial analysis at Xcel Energy? I would build a transparent model with separate historical data, assumptions, operating schedules, financial statements, outputs, and checks. I would link revenue, expenses, capital spending, depreciation, debt, and cash flow rather than hard-coding results. Scenario controls and sensitivity tables would test rates, weather, interest costs, and project timing. I use formulas such as SUMIFS, index match or XLOOKUP, and error checks, but the priority is auditability, clear documentation, and a model another analyst can review confidently. Focus on model structure, clean inputs, linked schedules, checks, scenario controls, sensitivity tables, documentation, version control, and avoiding hard codes. Mention functions only when tied to reliable analysis and reviewability. Question 22. Tell me about a time you found an error in a financial analysis. In a monthly forecast, I noticed that an expense trend did not reconcile with the underlying operational volumes. I traced the issue to a duplicated import in one regional data tab, corrected the source, and rebuilt the summary outputs. I immediately informed my manager, quantified the impact, and documented the fix. I then added a duplicate record check and a reconciliation to the general ledger. The experience reinforced that analytical judgment must be paired with disciplined controls and transparent communication. Use a concise star. Question 23. How would you explain a complex financial result to a non-financial stakeholder? I would begin with the business conclusion, then explain the 2 or 3 drivers that matter most. For example, instead of saying margin variance reflects several accounting classifications, I might say lower than normal demand reduced revenue while storm-related maintenance increased costs. I would quantify each effect, distinguish temporary from recurring items, and explain the decision implication. I would avoid unnecessary finance terminology, use a simple bridge or chart, and invite questions to confirm the message was understood. Mention starting with the business implication, using plain language, focusing on key drivers, quantifying impact, avoiding unnecessary jargon, checking understanding, and tailoring detail to the stakeholder's decision. Question 24. What key risks would you monitor when analyzing Xcel Energy? I would monitor regulatory recovery and disallowance risk, construction delays, cost inflation, financing conditions, severe weather, wildfire exposure, cyber threats, supply chain constraints, environmental requirements, and demand changes. I would also consider customer affordability because higher bills can influence political and regulatory outcomes. Rather than listing risks only, I would connect each one to earnings, cash flow, balance sheet strength, or valuation, then assign indicators such as project milestones, rate case decisions, credit metrics, and weather-adjusted usage. Cover regulatory disallowance, project execution, wildfire or severe weather exposure, financing costs, fuel prices, demand changes, cyber risk, environmental requirements, supply chains, and customer affordability. Question 25. What makes you a strong candidate for this financial analyst role? I combine strong financial fundamentals with a careful, practical approach to analysis. I can build and review models, reconcile data, investigate variances, and communicate conclusions clearly to both finance and operating teams. I am also comfortable asking questions when assumptions are unclear and documenting my work so it can be trusted. For Xcel Energy, I would bring curiosity about regulation and infrastructure, attention to detail, and the discipline needed to support reliable forecasts and sound capital decisions. Be sure to combine technical skills, accuracy, business judgment, communication, collaboration, curiosity, and evidence from prior experience. Tie your strengths directly to utility forecasting, reporting, investment analysis, and decision support. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.